Hello there, welcome to the Stock Genius channel, your go-to place for all things stocks and investments. If you're new here, we're thrilled to have you. Don't forget to hit that subscribe button like our videos and share them with your friends. We want to help you navigate the thrilling world of stocks and growth investments. Today we have something special for you. Do you have an extra $1,000 you're willing to invest? Well, you're in luck. We're about to reveal 3 top growth stocks you might consider buying right now with your $1,000. So fasten your seatbelts and let's dive into the world of growth stocks. Stay tuned and keep watching. Do you have an extra $1,000? Have you ever wondered what you could do with it? Well, one possibility is investing it in growth stocks. Growth stocks are shares in companies that are anticipated to grow at an above-average rate compared to other companies in the market. They're the shooting stars of the stock market, often tech-based, innovative, and disruptive. Investing in these companies can be a rewarding strategy. You see, if a company is growing, it's a good sign that its stock will follow that progress. So buying top growth stocks while they're down can lead to significant gains when they inevitably rise. This approach can turn your $1,000 into much more over time. But the question is, which growth stocks should you invest in? Well, we've got some suggestions. Well, stay tuned as we delve into 3 top growth stocks you might consider buying right now with your $1,000. First, let's delve into the world of cloud-based software with a company named Toast. Following in the footsteps of giants like Shopify, Toast has recognized the vast potential of providing industry-specific platforms. In this case, Toast is catering to the needs of restaurants, a sector that is increasingly reliant on digital tools to stay competitive. Toast's business model revolves around providing a comprehensive suite of software tools tailored to the needs of the restaurant industry. It's an all-in-one platform that integrates everything from point-of-sale systems and online ordering to kitchen display systems and customer loyalty programs. Now let's talk about Toast's recent performance. Despite the challenges that the global pandemic posed to the food and beverage industry, Toast reported a strong quarter earlier in November. Its revenue was up by 37% year over year. While this growth rate is lower than a year ago, it's important to note that the stock has fallen this year. However, here's where it gets interesting. Despite its recent growth, Toast stock is trading at just 2 times trailing revenue. This indicates that Wall Street might be undervaluing its shares. To put this into perspective, Shopify, a company in a similar line of business, has never traded below a price-to-sales ratio of 6.2. So why is Toast's valuation so low? The answer lies in its current profitability. The company is yet to reach its peak profitability, but there are clear signs that it's on the right path. Toast's gross profit increased by 50% year over year last quarter, outpacing its revenue growth and resulting in a narrower net loss compared to the year-ago quarter. Looking at the company's guidance, it's expected that revenue will grow by 32% year over year. This might have contributed to the recent pullback in the stock's price. But let's not forget that Toast is operating in a huge industry with over $900 billion in annual revenue. Toast's potential for growth is immense, with the company signing up thousands of new locations each quarter. Let's put this into perspective. The restaurant industry is a vast and diverse ecosystem, from small, family-run eateries to large multinational chains. Each establishment has unique needs and challenges. Toast's comprehensive cloud-based software platform addresses these needs, helping restaurants streamline operations, improve customer service, and ultimately increase profits. Moreover, as the world continues to digitize, the demand for such industry-specific software platforms is only set to grow. Restaurants, like many other businesses, are realizing the importance of leveraging technology to stay competitive. This, coupled with the ongoing shift towards online ordering and delivery, presents a massive growth opportunity for companies like Toast. Now, let's talk about the future. Given Toast's recent growth, its current valuation, and its potential for future expansion, it's clear that this company has a lot going for it. It's serving a booming industry, its software is being adopted at an impressive rate, and it has a clear path to profitability. So, if you're looking for a long-term investment, Toast is worth considering. It's a company that's poised for growth, operating in a thriving industry, and currently undervalued by the market. With a long runway of growth ahead and a relatively low valuation, Toast could be your ticket to long-term investment success. Next, let's switch channels to a player in the streaming industry that's making some noise. Roku. This small but mighty company is carving out a niche for itself, gaining viewers and going toe-to-toe with the industry's heavyweights. So, what makes Roku a promising investment? Let's dive in. Roku operates in the streaming industry, a sector that continues to capture the attention and wallets of consumers and investors alike. The company's business is divided into two segments: platform and player. The platform segment, which accounts for the lion's share of the company's revenue, is primarily driven by advertising. The player segment, on the other hand, deals with the hardware, Roku's streaming devices. Now, let's talk about Roku's recent performance. The company reported impressive results for the third quarter. Overall, Roku's revenue increased by 20%. What's notable is that this growth was achieved by both its segments, even though each has had its share of challenges in the past. The main driver of Roku's growth is the platform segment. This part of the business, which represents about 86% of total revenue, is where Roku has the most potential. As advertisers transition from traditional broadcast television to ad-supported streaming networks, the platform segment is set to benefit immensely. In fact, platform sales increased by 18% in the third quarter, signaling that advertisers are ramping up their budgets again after earlier cutbacks due to inflation. So, what's the big picture here? Well, Roku is not just surviving in the competitive streaming industry, it's thriving. The company's robust growth and impressive performance are testaments to its resilience and strategic prowess. Moreover, Roku's growth isn't just about numbers, it's about the company's ability to adapt to changes in the industry, to innovate, and to offer value to both consumers and advertisers. But that's not all. Roku's potential for future growth is also worth discussing. The ongoing shift from traditional TV to streaming is a trend that's unlikely to reverse. This means more viewers and, consequently, more advertisers will be drawn to streaming platforms. As a result, Roku's advertising revenue, the lifeblood of its platform segment, is likely to continue its upward trajectory. In addition, Roku's international expansion offers another promising growth avenue. The company has been making strides in expanding its footprint beyond the United States, and these efforts are expected to bear fruit in the coming years. Finally, let's not forget about Roku's strong brand and loyal customer base. The company's user-friendly interface, diverse content offerings, and affordable price points continue to resonate with viewers. This in turn helps Roku attract and retain customers, which is crucial for sustained growth in the cutthroat streaming industry. To sum up, Roku has a lot going for it. The company's solid performance, robust growth drivers, and promising prospects make it a compelling investment. Sure, there are risks, as with any investment, but if Roku continues on its current path, the rewards could well outweigh the risks. With a growing niche and an increasing number of viewers, Roku is a stock that could add some spark to your investment portfolio. Lastly, let's take a trip down to Latin America with a company that's dominating the e-commerce and fintech space, Mercado Libre. Founded in 1999 in Argentina, Mercado Libre has grown to become the largest online commerce and payments ecosystem in Latin America. Its platform offers a wide range of services to users, including marketplace, payments, advertising, and e-building solutions. The company's model is similar to that of Amazon and Alibaba, but with a significant twist. In addition to its online marketplace, Mercado Libre has developed an impressive digital payment system, Mercado Pago. This financial technology solution has been a game changer as it addresses the region's high rate of unbanked citizens by providing an accessible and convenient way to make digital transactions. Mercado Libre's recent performance paints a picture of robust growth. In the third quarter of 2023, the company reported strong revenue growth, driven by both its marketplace and fintech segments. Despite the challenging economic conditions in Latin America, the company's gross merchandise volume grew by a significant margin, indicating a strong demand for its services. But what makes Mercado Libre a good investment? Firstly, its dominant position in Latin America's e-commerce and fintech markets gives it a significant competitive advantage. The company operates in 18 countries, including Brazil, Mexico, and Argentina, which are among the region's largest and fastest-growing economies. Secondly, the growth potential in Latin America is immense. The region is witnessing a rapid digital transformation with an increasing number of consumers shopping online and using digital payments. Mercado Libre, with its established platform and wide range of services, is well-positioned to capitalize on this trend. Thirdly, despite its impressive performance and growth prospects, Mercado Libre's stock is currently undervalued. This creates an excellent opportunity for investors to buy into this growth story at a relatively low price. However, investing in Mercado Libre is not without risks. The company operates in a region known for its economic volatility and political instability. Moreover, as the company continues to invest in growth and expansion, it is yet to achieve consistent profitability. But here's the thing. Every great growth story comes with its share of risks. What's important is that Mercado Libre has shown resilience and adaptability in the face of challenges. It has consistently innovated and expanded its services to meet the evolving needs of its customers. In conclusion, Mercado Libre presents an intriguing investment proposition. It operates in a rapidly growing market, has a dominant position, and offers a wide range of services that cater to the evolving consumer behavior in Latin America. Its strong performance and undervaluation make it a compelling pick for growth-oriented investors. With a dominant position in a region experiencing rapid digital growth, Mercado Libre could be the growth stock that gives your investment portfolio a Latin flavor. So, there you have it. 3 potential growth stocks you might consider for your $1,000 investment. Let's take a moment to recap why these stocks are particularly compelling. First, we have Toast, a company that is following in the footsteps of Shopify by providing cloud-based software solutions to businesses. Despite a slightly slower growth rate this year, Toast's revenue has still increased by 37% year-on-year, and the company continues to sign up thousands of new locations each quarter. With its shares potentially undervalued by Wall Street, this stock could be a long-term winner. Next, we have Roku, the unsung hero of the streaming industry. Not only did the company see a 20% increase in revenue in the third quarter, but its growth is coming from both of its segments. As more advertisers shift from traditional broadcast television to ad-supported streaming networks, Roku, with its dominant platform segment, stands to benefit greatly. Finally, we have Mercado Libre. While we haven't delved into the specifics of this company in this scene, it's worth noting that it's another strong contender in the growth stock arena, with its focus on e-commerce and online financial services. Investing in growth stocks like Toast, Roku, and Mercado Libre offers the chance to get in on the ground floor of some potentially explosive future profits. These companies are all expanding, innovating, and carving out niches in their respective industries. It's important to note that while these stocks have the potential for high returns, they also come with a degree of risk. It's always a good idea to do your own research, understand the company and its business model, and make sure it aligns with your financial goals and risk tolerance. Remember, the best time to invest is now. Your future self will thank you. Before we wrap up, it's important to remember that investing isn't a guaranteed way to make money. While the potential for high returns is there, so too is the risk of loss. Always invest with caution and never put in more than you can afford to lose. When investing in these growth stocks, or any stocks for that matter, it's crucial to stay informed about the companies, their performance, and the market trends. If you're not comfortable making these decisions on your own, consider seeking advice from a financial advisor. Now, armed with this knowledge, it's time to make your move. Remember, the best investment strategy is one that aligns with your financial goals and risk tolerance. So, whether you're investing $1,000 or $1 million, make sure it's a decision you're comfortable with. Thank you for watching. We hope you found this video informative and helpful. Don't forget to subscribe, like, and share our videos. Your support helps us continue to provide quality content. Until next time, happy investing.